Welcome back to Finyugen, Systematic Investment Plan or SIP as it is commonly known is an investment plan offered by mutual funds wherein one could invest a fixed amount in a mutual fund scheme periodically at fixed intervals, say once a month instead of making a lump sum investment. Marketing of SIP informs that it is easy for investors to buy equity or debt mutual funds regularly through SIP in order to build substantial wealth. It is also marketed as a safe and sure route for investments in equities to create a wealth over the long term. Media has been used to create hype about SIPs that has made it as the preferred route for retail investors to invest in mutual funds. Let us examine the plain facts about the SIP and check if it can be effectively used by us to build wealth. Basic understanding of SIP. SIP is nothing but a regular investment plan, mostly monthly or quarterly, of a particular amount in a mutual fund scheme. It is similar to a recurring fixed deposit with the bank, which allows an investor to deposit a small amount at regular intervals instead of a single one-time investment. It is also known as rupee cost averaging. In this method, more units are bought when the market price of shares is low and lesser units are bought when the price is high. Through this mechanism, the investment risk is spread across market movements. This is the primary advantage of a SIP, which is effectively used by the fund houses to market it as the magic formula to attain financial freedom. Investing in regular interval. SIP regularizes the investment process by making it mechanical. Once chosen, SIP will inculcate the habit of investing regularly. It creates discipline among the investor and investing becomes habitual. This makes the investor very happy as it compels the investor to save some money for the future livelihood. Actually, it benefits the mutual funds and distributors because they get continuous flow of money for the long term on which they can earn a fixed percentage of fees and commissions. It is also safe for financial planners to recommend because if anything goes wrong, they can blame the SIP concept. It is a win-win game for both investors and for mutual fund operators, so it has become very popular now. Does it really help you? Investors use two methods to analyze the risk associated with their investment in stock market. They are fundamental analysis and technical analysis. Technical analysis insists on timing while fundamental analysis insists on valuation to reduce the risk of investments. SIP does not follow any of these methods. SIP is not a strategy to attack the market to get the best out of it. Instead, it is just a methodology to cultivate a discipline to inculcate saving habit. Of course, it minimizes the risk of investing in any volatile markets. Risk-averse investors are bothered about worst-case scenarios, as well as the potential feelings of regret that would occur if a lump sum investment were made immediately prior to market decline. It removes emotions and uncertainty from your investment plan by making it a mechanical, boring process. All these are correct and accepted facts. But remember that there is much beyond SIP to make us financially rich if you have to invest in the markets. After all, by a simple plan like SIP cannot make you rich. However, it could make the distributors and the financial planners rich. Here is the truth. In fact, most of the mutual funds underperform with respect to benchmarks over short and long term, not only in India but also in US. Is there anything we can do with SIP to outperform the market? We turned on to the financial sannyasi Warren Buffett. Although there are no guarantees in stock market, Buffett's conviction that index funds are a smart investment is a solid advice that almost anyone can follow. Legendary investor Benjamin Graham, mentor to Warren Buffett, in fact advocates the retail investor to invest in the index fund. Index funds are a form of passive investing. They hold every stock in an index, which includes all the big names and eliminates the bias of the fund manager while picking the stock. Tony Robbins also agrees to this concept. In his book Unshakable, he writes, "Index funds take a passive approach that eliminates almost all trading activity." He further explains that funds eliminate the human error and therefore the risk that comes from trying to pick stocks individually. Final words. Now we have come to the end of this educational video. Before I conclude, I would like to take my advice from my mentor on this topic. Let me ask him few questions. Guruji, is SIP right?
No doubt about it. SIP is the right methodology if done on the right instrument. It will result in compounding of your investments at a much faster rate than your fixed deposits.
Mutual funds sahi hai?
Bilkul nahi. It's pretty difficult to select the right mutual fund by a normal retail investor. Besides, mutual fund is totally dependent on its fund manager, so please avoid it.
I'm now confused. You have said SIP is right, but investing in mutual fund is wrong. Where should I do my SIP?
It's very simple. Just do it on index fund. That should help you to achieve your goals faster.
Yep, that's clear now. Thanks, Guruji. Before I sign off, I would like to wish you all good luck to multiply your investment at faster rate using SIP. I'm sure you would have liked this video. To come up with more videos like this, please do like, comment and share this video with your friends. Subscribe to our channel for more updates. Also, visit our blog at finyugen.com where you will find many interesting articles.